Welcome. Today, we're going to dive into a really critical tool in Canadian tax planning, the Section 85 rollover. Now, if you're a business owner who's thinking about making the leap from a sole proprietorship to a corporation, this is something you absolutely have to understand. Because getting this right can be the difference between a smooth transition and a massive, unexpected tax bill.
So, let's begin.
As a business grows, many successful owners get to a point where incorporating just makes sense. It offers you that crucial limited liability, which keeps your personal assets safe. And of course, there's the potential for lower corporate tax rates. It's a very natural and often really necessary step in the evolution of a successful enterprise. But here's the catch. The process of moving your existing business assets, things like your equipment, your inventory, maybe even goodwill, into that new corporate entity, well, it's not as simple as just moving boxes from one room to another. You see, from a tax perspective, your sole proprietorship and your new corporation are two completely separate legal people. So a transfer between them is considered a disposition. And for tax purposes, a disposition is basically a sale. This is where the problems can start.
So why is that a problem? Because that sale is automatically considered to happen at the asset's fair market value. So if an asset has gone up in value since you bought it, you could be looking at capital gains. If you're transferring inventory, that might be treated as business income. And for any depreciable property, you could trigger something called a recapture of the depreciation you've already claimed. All of this can create a huge immediate tax bill, even though not a single dollar of actual cash has changed hands.
So how do we get around this? Well, in this explainer, we're going to break it all down. First, we'll dig a little deeper into the tax problem itself. Then, we'll introduce the really elegant solution found in the Income Tax Act. We'll walk through the mechanics of what's called the elected amount, what you get in return for your assets, and how this whole process sets you up for the future. Let's get right into it. Okay, so let's really unpack this. Why on earth does the Canada Revenue Agency see this as a taxable event? I mean, it really feels like you're just moving money from your left pocket to your right pocket, doesn't it?
And right here, this is the fundamental disconnect. The tax system sees two legally distinct entities making a transaction, and the default rule is that it happens at fair market value. But you, the business owner, just see a simple restructuring of a business that you still 100% own. This tax hit could actually stop a lot of businesses from incorporating, which is precisely why a solution was created in the first place.
So that's the problem. But thankfully, the Income Tax Act provides a very specific, very powerful mechanism to solve this exact issue. Section 85 allows you and your new corporation to jointly elect a transfer price. We call it the elected amount, instead of being forced to use the fair market value. Now, by choosing this amount strategically, you can defer any capital gains and recapture that would have otherwise been triggered. I really want to stress that word, deferral. You're not eliminating the tax. That tax will eventually have to be paid, but you're pushing that day off into the future.
Okay, to really wrap our heads around the mechanics here, theory is not going to be enough. We need a solid, concrete example. So for the rest of this explainer, we're going to follow the transfer of a single depreciable asset, let's call it a machine, from a sole proprietor to their newly formed corporation.
These three numbers are absolutely critical to everything that follows. First, the fair market value, or FMV. This is what the machine is worth on the open market right now, $100,000. Second, the original cost. This is what you paid for it way back when, $90,000. And third, the undepreciated capital cost, or UCC. Think of this as its remaining value for tax depreciation purposes, $85,000. Keep these three numbers in your head. The entire Section 85 transaction really hinges on this one key concept, the elected amount. This is the figure that you, the person transferring the asset, and your corporation jointly agree upon for the transfer. The best way to think about the elected amount is as a deemed sale price, but instead of the government forcing you to use the $100,000 fair market value, you get to pick a different number, within certain limits of course, that works for your tax situation. It's a powerful choice. Now, this one number is incredibly powerful because it does three completely different jobs all at once. First, it sets your proceeds from the sale. Second, it establishes the corporation's new cost for that same asset. And third, it dictates the cost basis of whatever you get in return. It is truly the linchpin of the entire transaction. So, what number should you pick? Well, the main goal here is usually to avoid triggering any immediate income. For a depreciable asset like our machine, that means you should elect at its tax cost, which is its UCC. If we were talking about a non-depreciable asset like land, you'd typically elect at its original cost. So for our machine, we are going to choose an elected amount of $85,000. By setting your deemed proceeds exactly equal to the UCC, the math for recapture works out to zero. That potential tax hit on the $15,000 difference between the market value and the UCC, it's been successfully kicked down the road. Now, of course, this transfer isn't a gift. The corporation has to give you something of value in return for the asset. We call this consideration. And that consideration has to include shares in the new company, but it can also include non-share consideration, which we commonly refer to as boot. The key principle here is simple. The fair market value of what you get back must equal the fair market value of what you put in. You transferred a machine worth $100,000, so you must get back a total of $100,000 in consideration. In our example, we're going to split that between cash, our boot, and some preferred shares. Now, listen closely, because this is a fundamental, unbendable rule of Section 85. You cannot pull more non-share assets, or boot, out of the corporation than the elected amount you've chosen. So since you probably want to get as much cash as possible, you'll take boot right up to that limit. In our case, the limit is our elected amount of $85,000. The rest of the asset's value, that extra $15,000, must be taken in the form of shares. We're not quite done. We're in the home stretch, but we have to do one more critical piece of accounting. We need to figure out the tax cost, or what's called the adjusted cost base, ACB, of the boot and the shares you just got. This is so important because this ACB is the number you'll use to figure out your gain or loss when you eventually sell those shares. The allocation follows a very strict order, like a waterfall. Your total available cost base to hand out is equal to your elected amount, so $85,000. The rules demand that this cost base gets assigned to the boot first, up to its fair market value. Then, whatever is left over gets assigned to the shares. And here's the final result of that process. We had $85,000 of cost base to work with. We assign it to the boot first. The boot is worth $85,000, so it absorbs the entire cost base. And what does that leave for our preferred shares? A big, fat zero. The allocated ACB of the shares is zero. This is the deferral in action. Those shares are worth $15,000 today, but for tax purposes, their cost is nothing. That means when you eventually sell them, the entire amount you get will be a capital gain. All right, let's zoom back out and pull all of this together. Let's summarize the absolute key takeaways from the Section 85 rollover. These are really the core principles. First, and most importantly, remember Section 85 is not a magic wand that makes tax disappear. It's a deferral tool. The tax liability is just parked inside those zero cost-based shares you now own. Second, the elected amount is the key that unlocks this deferral. Third, the rules around boot make sure you can't just cash out the gain tax-free. And finally, the whole point is that the low tax basis of your old asset gets transferred or rolled over into the new shares. So this one transaction actually creates two future taxable events. The first one will happen when the corporation eventually sells the machine it received. Remember, its cost for tax purposes is only $85,000, not the $100,000 it's worth. The second taxable event happens when you sell your shares, the ones that have a cost base of zero. Understanding how to manage both of these future liabilities is really the next step in mastering your tax planning. Thank you for your attention.